Good afternoon and welcome to the Future of Finance, where today we will discuss wealth managers and their need to disrupt themselves. I shall now hand you over to Dominic Hobson and the panel. Thank you very much.
Hello everybody and welcome to our webinar, Wealth Managers Need to Disrupt Themselves. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion today, sponsored by Trade and Invest Wales in partnership with FinTech Wales. Now, wealth management is a venerable industry, a long history and a forgivably conservative approach to change. After all, wealth managers are looking after other people's money. But they're now facing a series of tests, set partly by regulation, but mainly by generational change, technology, and competition, and especially the forms of competition that the combination of technology and generational change sets in motion. I was interested to read in the BG Global Wealth Report, the wealth management industry of today is sharing a profits pool of exactly the same size as it had before the great financial crisis way back in 2007, despite a tripling in the value of global wealth in the interim. So clearly something very interesting is going on in the wealth management industry. To help us find out what it is, I'm joined by four individuals who approach this question with four very distinctive approaches. Sarah Williams-Gardner is CEO at FinTech Wales, the voice of FinTech in Wales, which has in the 2 years since it was set up helped a variety of disruptive new entrants, digitising incumbents and tech providers to launch and grow. Andrew Russell is the CEO at Wealthify, a digital investment management service backed by Avivas, whose purpose is to inspire anyone to build their future wealth and aims to do this by offering a simple, straightforward and low-cost way for people to invest. Professor Arman Ishraghi is Professor of Finance and Investment at Cardiff University, where he has specialised in studying the costs of asset management and taken a close interest in the application of data science to asset and wealth management. Gareth Lewis is co-founder and CEO at Delio, a financial technology firm that enables wealth managers, banks and other institutions to digitally connect their clients with private market investment opportunities. In addition to our panelists, we also, of course, have you, our audience. We want your questions, we want your comments, so do please send them, keep sending them throughout the webinar using the Q&A functionality at the bottom of the screen. We will not be saving them up to the end, but we'll address any questions which come up as we go along, so you can be an integral part of this conversation right from the beginning. And we're going to be disappointed if you don't take that opportunity. But I'd like to kick our discussion off with the point that I made a minute or two ago. 3 times the volume of wealth, but the same value of profits. Is wealth management less healthy than it ought to be? This is an industry which used to rely on an aging population, a growing economy, generous tax incentives to save money, and of course, last but not least, rising stock market performance. Andrew, perhaps I could come to you first. Is the wealth management industry failing to respond to a changing macro reality in the financial markets?
I don't think so. I mean, quite a few of the things that you've just articulated there are still present. There's some changes clearly, but I think the onset of robo advice, for example, the robo advice market that followed the financial crisis is showing that the wealth management market is adapting to the new changes that are coming. There are new customer demographics that are being attracted to the market as technology providers like ourselves are attracting them to. We're seeing a big shift from savers to investors, and that's kind of one of the ways that we're looking to serve our customers is to try and attract as many savers to investors as we can to help people build their future wealth. And we're seeing that market grow quite considerably.
Mm-hmm. What about my narrow point there about this BCG fact that there's been this massive inflation in the value of investments, but somehow the wealth management industry hasn't been capitalizing on that? You've just made an investment in a wealth management business, so you must see an opportunity somewhere inside it. What's the thinking behind what you're doing as opposed to what's happening in the market as a whole?
Yeah, I mean, Avivas' rationale for purchasing Wealthify, I think we're probably threefold. Firstly is the economics of the deal, buying a small startup and seeing it, supporting it grow in value and seeing that investment grow in value. There's also kind of planning for the future as well. There was a very clear drive and growth in the robo-advised market or digital investment management market, and it is attracting newer, different customers from the more traditional wealth managers. And then thirdly is learnings in both directions, both from Aviva into Wealthify as we mature, but also then Wealthify back into Aviva on agility and technology. The products, the wealth management products in Aviva are still generating profits and growing, and Wealthify is still growing quite considerably. So I think it's probably more a wider topic for discussion around if the profits are staying the same, but the assets under administration or assets available to invest are growing, then there's probably a shift from the larger margin product into the narrower margin products.
Mm-hmm. Okay, we'll come back to that, because if margins are getting squeezed, we need to think about costs. But before we do that, Sarah, perhaps you could give us a few thoughts on what you think is happening, particularly on my point about a generational change. I know this is something which you've seen in your own experience with Starling Bank. Is this new generation of customers more difficult and less profitable to deal with, or just different?
I don't think they're more difficult to deal with. They might be more demanding, and quite rightly so. But I think it's really interesting just to pick up on the point that Andrew made very well. Turning savers into investors is the way that people are actually going to get some return on their money at the moment. There are, the interest rates are so low, but we also need to democratise this world of investment. We need to ensure that it is seen as approachable by let's say the next generation. You talked about aging population in investment, and certainly when we see what's happened with legislation and we see what's happened in the disruption that's happened in the market, that we're all very familiar with, that we refer to as the FinTech disruptors, we're democratizing access to more products for more people. And I think this has to be a very good thing. So no, I don't think they're difficult, but I think they are more demanding, and we'll come on later to the types of investments in which they like to participate. But I think what's been interesting is, and I can say this from the challenger market perspective, is rather than the banks wanting to be all things to their customer, they are actually taking a different approach, which is to partner with organisations. And we had the benefit and the good pleasure to actually partner with Wealthify, and so therefore what it is doing, it is opening up markets, giving easier access through new technology, through well-designed interfaces, through very clearly communicated products to encourage more people to enter into the market. So no, I don't think they're difficult, but I think it's a really positive thing to make available more of these newer, easier ways of investing for more people, given that we're just not getting any return on savings. In fact, I think there's most probably some stats that tell you if you leave your money in a current account, you're actually losing money.
Sometimes formally, of course, depending which currency you're in, they actually give you a negative rate of interest. But it's an important point, that about how you turn traditional deposit savers into investors, and it raises the question of whether the mass affluent segment, in the wealth management, we tend to divide it up into very rich people, ultra high net worth, and then high net worth, and then affluent, and then mass affluent, how we can make mass affluent investors a profitable proposition. You're dealing with a lot of people with relatively small amounts of money, and I'm sure Gareth will have something to say about how you keep those costs down, because it must be largely a cost play. Partnerships also a very important thing to talk about. But before we go on to those, perhaps I'd like to bring it'd be good opportunity to bring Armin into the discussion at this point, to kick us off really on keeping costs under control, because I know, Armin, you've done a lot of work on costs in asset management, and I'm wondering how well, or what sort of steps you think wealth managers could be taking to keep the cost of asset management under control.
Right. So thank you for that very insightful question. There has been a lot of pressure, as you correctly mentioned, on wealth managers and fund managers in general. And the elephant in the room is, of course, passive strategies, passive investors, and so on. So the active-passive debate, I think, is still raging on. In the academic circles, we are still writing and publishing papers on the skill versus luck debate and how to distinguish real investment skill on behalf of the active investors. So there is that rational argument, rational debate, which is still going on. But there's also I think, in my view, there's also the need for human touch, which the passive platforms and passive investors do not provide. Personally, I think the direction to go, I think most of the growth will happen in hybrid platforms where there is scalability afforded by fintech, where there is an engine for investment advice backed up by algorithms, backed up by recommendation softwares. But there's also the human touch through distance communication technologies where somebody is doing the hand-holding in difficult times. And I think this also goes back to Sarah's point about fairness and democratization. There has been a lot of pressure, according to academic studies, on as far as cost is concerned on active investors, and part of this comes from passive. Part of this comes also from new innovations in the wealth management space, including, of course, digital wealth management and robo-advice.
Gareth,
yeah.
One of the points which Armin made before we lost him was that in wealth management, you have this dilemma. You've got to retain the human touch, but you've also got to keep your costs under control. To what extent can technology enable you to excel at relationship management and client service without losing that human touch? A machine is not the same thing as a human being, but talk us through it. How can it be done?
Yeah, absolutely. I think just kind of pulling together thoughts from both of those questions. I think, we do have this new generation of wealth creators that are fast emerging, and I think arguably more financially savvy than previously because information is more accessible. I think lots of young people now view themselves as investors, entrepreneurs, philanthropists in some way, shape or form, right? So I think that trend is happening and people are actively engaged and want to do more with their money in a certain lens. You've kind of, they're in their wider lives, obviously more tech savvy and more engaged. So they're able to adapt and engage with new technologies quickly, easily and effectively. But at the same time, you go back to the history around wealth management, private banking and the like. And I think you've got a desirable objective and target for many of these wealth creators. Having a wealth manager or being part of a private bank is exclusive and desirable in a number of lenses. So that's where and with that, inevitably, you're going to want the human touch as well. So whilst I think the technology component is hugely important, Arjun's point was absolutely right around that omnichannel approach being most effective. Now, there's going to be one side which I think is going to be more expensive than the other, which is going to be the personal touch. But I think if you can get that process of adopting technology for digitization, process automation, and focusing on, I guess, eliminating lots of the processes that do take up a lot of time, that should, in theory, allow you to focus on that arguably less profitable outcome, but also more rewarding and engaging. So in the long term, perhaps more profitable, depending on how you cut it. So I think it's about, for me, it's about automating, digitizing those areas which can be digitized. And then that allows wealth managers, private bankers, or whoever to spend more time on building those client relationships, increasing touch points, potentially delivering new service lines and creating new monetization opportunities.
If I just add to what Gareth said, sorry, Armin, do you want to follow up on your earlier point?
No, please go ahead.
No, I was just going to agree with Gareth. Even in the kind of robo-advice space where you may think the majority of it is automated and digitized, the majority of our customers still want that human customer care center, the operation center, to ring up because we're dealing with people's money here. They want to know that it's a real thing. They're happy to digitally interact, but they want to know that someone's at the end of the call, at the end of the phone, in case anything goes wrong. And I think in all that spectrum of wealth management, whether you kind of standardized and digitized up to personalized touch, you need to get the right balance between automation, digitization, and personal touch for where you are on that spectrum.
Yeah,
Did you want to finish what you were saying, Armin, when we lost you?
Yeah, yes. Sorry, when we were talking about technology, and then technology fails, of course. So the relationship between humans and technology is really fascinating, because, of course, there is interesting research which shows when an algorithm fails, as a human consumer of the algorithm, as the client, you blame the closest human involved. So not the algorithm. So the algorithm is never culpable. It's the coder. It's the person behind. So interestingly, we both need trust. We need trust, humans, but also we need humans to blame. You can never blame the software or the algorithm. And so I completely agree. It's ultimately about the balance. And I don't think without the human touch, you can provide the full-scale service. Especially for higher segments of the wealth management market, such as high net worth and ultra high net worth clients. You do need that, but across the whole sector. And also, I would say, especially in turbulent times, because when the markets are jittery, you really need that hand-holding. You also need to pacify clients about fear of missing out. So they hear things about, oh, am I in crypto? Am I sufficiently in crypto or not? And again, I believe the algorithm would not be able to provide that level of assurance, human touch again.
Well, we're going to come back to crypto. Sarah, you want to say something? I have a question for Andrew, which I wanted to pick up from something you said earlier, but you wanted to say something, I think.
All I was going to add to was Armin's point, and he eloquently started to move on to trust. And I think, in this post-financial crisis, disruptive fintech, new entrants to the market, a lot of this is about building trust. The banks and financial providers in the larger market, maybe not the high net worth or the ultra high net worth, where there was that client relationship to assure and take the client through those turbulent times. But I think when we talk about the larger markets, this point on trust can't be underestimated. It's highly significant.
Thank you, Sarah. So, Andrew, I'd like to pick up the point Sarah made earlier about servicing mass affluent investors, if I can call them that, commercially viable. Now, and add to it something which Gareth said, which actually this isn't a binary choice between being digital or being human. You have to be all of these things. It's got to be omnichannel, as he put it. And you yourself are saying that people still want somebody at the end of the telephone. And Armin was saying, people don't trust the machine, they trust the humans. So how do you create a successful and profitable business for mass affluent investors? Here you are, got all these people saving in bank deposits, losing money in real terms. Yeah. It's a massive market for you, but how can you make it pay if you've got to be omnichannel?
We talked about that scale earlier on of where people, the kind of mass affluent are the kind of smaller pot sizes that people have to invest. That are still a hell of a lot of money to them. I know £1,000, £2,000, £3,000 may not seem lots of money to the wealthy, but it means a lot of money. It certainly means a lot to me, and it means a lot to a lot of people in the UK. So previously, I think they have people with that size pot size have struggled to access investments, despite the fact that investments have over a longer period, which is when they should be invested for, have outperformed all savings rates. But savers have of that size have historically not benefited from the increments that an investment product would give them. I think the onset of technology is ultimately the answer there. We are built on technological platforms that allow customers to come into our platform in an accessible, easy and affordable way. You can invest with us from as little as £1. And we make that business profitable. We're growing that business materially because it is giving access to investments for a new cohort of people. You need to get that balance right. As we've said, people who are dipping their toe in investments for the first time will be the people who on the acquisition journey just want to ring up and check that they're doing the right thing, or that the money's landing in the right place, or just want to query something around what investments is, what they're invested in. So it is vital to have that human contact. And we have humans investing as well. The robo element is maybe a little bit misnamed in the market. It's around rebalancing the portfolio rather than stock selection. But all that technology has been used to bring the cost down to a level that allows mass affluent customers to access investments and to bring as many savers to investments to become investors as possible.
Before I let you go, we've had a question here, which is, and it prompts a second thought in my mind, which I think is quite important. It's, do women invest in a different way from men, and are wealth managers developing services aimed at women? And the thought I had earlier is that one of the things Gareth mentioned was that young people have a more entrepreneurial mindset. They see themselves as entrepreneurs, they're engaging in this economy for a whole variety of motivations, but they certainly are comfortable with business as culturally comfortable with it. Do you, in terms of trying to develop products and services, categorize people by these sort of identities as women, as entrepreneurs, as professionals, as, I don't know, people who own a lot of land or anything else? Is that kind of work possible, and does it make sense as a provider of wealth management services to think of people in those sort of categories?
I think labeling and treating women differently from men is not necessarily the right way to look at it, but there are definitely customer behaviors of certain demographics that will look for different things. Like, some people may be more digitally native than others, whether they are male or female. They may be more open to investing in an investment product that has a digital journey than some other people. It's the same with age as well. We have between Aviva and Wealthify, we have a range of ages. I've got some people, a good slug of my customers are in retirement, and some of the Aviva customers have a good slug of their customers at the younger age. I think it's around how people interact with investments and how what people's propensities are to engage with certain things and kind of how they're built up, rather than labels of gender, age, affluence levers. You can kind of get a population-based, data-driven insight into where the most likely optimization point is for certain categories, and all that's kind of readily available from kind of the data miners and data scientists in the industry. There's lots of people ready to sell you information on the general public and how they generally behave as a cohort. But that's probably more around targeting rather than categorization.
Yeah, sorry, it was an unnecessarily clumsy question. I can see that okay. It needs to be more granular than I was implying. But let's talk a little bit about how you actually innovate in this space, and perhaps Gareth, you'd be a good person to start us off in this area. I, for example, was offered the other day the opportunity to become an investor in a company whose intent is to gamify investing. In other words, using cartoon characters and making it more like a computer game in which you can actually play the game and get some extra interest in your account or get some dividends or whatever. So what does innovation in wealth management actually look like? Is it about the customer experience in the way I've just described, i.e. the service? Is it about the products you develop? Is it about the processes that you do? How do you innovate in wealth management? Do you have to innovate at multiple levels?
Yeah, I mean, I think I look at it quite, from a pragmatic perspective in terms of where the industry's, at more broadly. And I think in terms of digital adoption historically, probably hasn't been the fastest moving as we discussed earlier. I mean, it's, I think more broadly across the industry, I think there's so much of this world ran off Excels, emails, PowerPoint, and pen and paper. So when I kind of see these, what I kind of refer to as technology for technology's sake, when people are doing this and that in this world and kind of maybe 30 steps ahead of everyone, I kind of look at it a little bit in the lens of being, is that really where the industry is right at this moment in time? So from my perspective, I think innovation in the industry is adding value. So it's if we're a B2B white label service, so we're selling to banks, and the three main things we sell by, and I think these are the three key elements from my perspective in wealth management innovation for the time being, is about increasing revenue opportunities, improving operational efficiency and reducing risk and compliance overhead. And I think they're the three key challenges that any technology innovation needs to really be tackling to be relevant in the industry. If you're not if you're not actually solving any of those problems, then I think your mission to be a player in the industry in some way, shape, or form is going to be pretty difficult. Now, I'm not saying those technologies that are emerging and coming over the landscape are completely useless or not valuable. There's obviously a lot of value to be had from the power of data analytics and insight. There's going to be a lot of value to come from digital asset tokenization and some of the technologies that underpin things like cryptocurrencies. So yeah, I think innovation in wealth management is I think it's keep it simple in a lot of senses, and I think that's what's going to drive value in the industry, because you can't really run before you can walk, can you?
I think, Dominic, if I just pick up on that, I think all of the points that Gareth is making are really valid points. I think the challenge here is when you are going to a mass market for investors and you're looking to increase your consumers. And we all know that a B2C offering and marketing and getting to those consumers is a very difficult thing to do. And therefore, where we are seeing people gamifying some of their products, it's in that early stage of where they're trying to get people to engage, to start thinking about these things, and it might not be the way the product ends up delivering, but it does create the conversation and it does create interest in the market, and it can appeal to some of the newer investors, in the way that when we talk about innovation, we talk about very simple things like rounding up in your bank account. If you buy a coffee and you put the round up, be it 30 pence, 20 pence every single time into an investment, which with the new providers you can do that. You can. I mean, Andrew alluded to Wealthify. The entry level is £1. And the moment you start investing, you start getting compound interest, you start getting benefit from these things. So to start getting people into the market, there may be some of these gamification approaches, but the market will innovate in many different ways. The efficiency of delivery to the things that Gareth is alluding to is absolutely imperative. But I think in order to get that mass market, sometimes you might see innovation in ways that we might not have thought about. We're seeing people introduce the sort of almost like a reverse marketing, where if you do say yes to having your data shared, you're getting value back from that these days, rather than the people who own your data actually marketing to you or selling your data. So I think there's a lot of things changing in the marketplace, but gamification is possibly a way that people are just encouraging the conversation. There will always, in my personal mind, there will always be the space for humans for that reassurance and trust.
Now, Andrew, I'd like you to think about some of the things which Gareth said, which is about the regulatory burden and the lack of investment by the industry in technology. But before you answer those, I'd like to bring Armin into the conversation about innovation, really. And Armin, you talked earlier about passive investment as being a serious competitor for wealth management firms. You began to touch upon technology. I'm wondering to what extent fintechs are becoming a serious competitor for established wealth managers. I'm also wondering to what extent you think the likes of the FANGs, the Facebooks, the Googles, the Amazons, how are they limbering up off stage somewhere to enter this market and deliver the scale which Sarah and Andrew have talked about very quickly?
Right. So this goes back to the very interesting question on big tech versus big finance, and I believe big tech has indeed a lot of muscle power to enter into finance. However, it's probably certain areas of finance where they might encroach on sooner, and they have already, such as digital payments, etc. When it comes to wealth management, while it might be likely that the FANGs might enter that, my feeling is that probably that is, we're still not there yet in that respect. I think it's too technical. I think it requires a deep understanding of how investments are made, and it's just another ball game. So I think that's relatively unlikely in that respect. There are information privacy considerations, and there are a lot of consumers who think, well, a company like Google already knows so much about me, I'd rather keep my finances to myself at the very least. So there's that. However, we have in the wealth management space, we've seen two types of, I guess, competition. So there's one group which is the startups, like the Betterments and Wealthfronts of the world, which initially were private startups and they've grown very well. But we're also seeing fintechs and robo-advisors, for example, associated with the big finance players like the BlackRocks and Vanguards and so on. So I think there are two different breeds of wealth advisors who are competing together. And I think that battlefront would be very interesting to watch. Regarding innovation, I just thought of two interesting examples. Obviously, the tech itself is 24/7. It never sleeps, right? That when you have a digital wealth management platform, it never sleeps, it never gets tired, unlike a human advisor. And I think that's where the innovation is happening. So these platforms are constantly monitoring and rebalancing your portfolio, or in theory, they can do so. And for example, as you know, this is from financial psychology, we're all loss averse. We all hate losing money more than we enjoy winning money of the same amount. So this is well documented. And because of this, when you have a portfolio as a human, you're likely, when some of your stocks go up, you're likely to sell them. But when some other stocks go down, you're likely to keep the losers and not sell them. Because when you sell the losers, the losing stocks, you realize a loss, which is psychologically very painful, right? So, okay, so the tech platform can give you alerts, can provide stop losses into your investment routine and so on, in a very systemic way that a human advisor probably cannot. So that's interesting. And also, the last thing I want to say, you mentioned gamification. There is an interesting study that shows when you show investors their future self. So let's say you take a young person's image and make it old and show them that, for example, in 30 years time, they might reach pension age and this is how they might look. Then they relate to their future self much more closely, and then they start thinking very seriously about saving for the retirement, which is very interesting. So there are ways in which platforms can nudge you to think about the future, about saving, about investing, which is again tech enabled, and we didn't have that 10 years ago.
I think maybe Aviva is running an advertising campaign based on exactly that. Where a young man looks into the mirror to see his older self. Who is that? Is it you, Andrew?
Yeah, I think we've got that at the moment. There's lots of apps available in the market as well. My daughter at the moment is nagging me to get an app where you kind of just go on a little scroll bar and it changes your face as you go. So there's lots of that about in the market.
Okay. Well, I'm glad it wasn't around when I was younger. I'd be horrified to see my present self. I asked you a minute ago, Andrew, to think about one of the things that Gareth raised about compliance cost, compliance risk, lack of investment in technology, because we talked a lot about innovation here. And one of the things Armand said is that what somebody puts off the fangs from investing in this area, of course, is the fact you have to be very heavily regulated. So regulation and compliance is a real burden, and there's not a total technological solution to that. But how is it reached the sort of unaffordable stage now, unless you are a certain size?
I don't think so. Otherwise, we wouldn't have seen lots of the new entrants come in the market. I completely agree with Gareth. I think we are investing people's hard-earned money here. This is their life savings in generally what we're talking about. So we need to make sure that there are appropriate policies and controls and processes around the industry to make sure that we're protecting people's money. It's vitally important that we get that right. So I'm in favour of regulation. I think the two things that we could improve are on proportionality and consistency. So, for example, me as a small startup with kind of quite small level of regulations, to try and keep it simple, has to hold a similar kind of proportionate quantity of capital as a bigger player, that has more that takes on more regulatory risk. There's certain permissions that they hold will hold a wider array of permissions that create more capital requirement. And so looking at that proportionality and making sure that the regulator is applying that throughout the industry is important. And then the second piece is on consistency as well. To enter into a robo-advisor, if you put money in Wealthify, you have to go through a suitability assessment. It's a 15 question long set of questions that checks that your appetite for risk is set at the right level that you've told us, which is vital to make sure that we're not putting people's money to work in the wrong places, that we're investing at the right level for your kind of risk of loss, volatility, and time horizons. So that's really important. I think we could improve on that as an industry, but people, we get lots of our customers getting annoyed at having to answer 15 questions to be able to put their money with us, when they can go and put their money in Game Shop and maybe temporarily rise, but then gain. They can self-select without the same rigor as you do on robo-advice, and similar with full fat advice. So I think I'm a big fan of regulation. We need to get it right in the right areas, and for me, you do that via proportionality and most importantly, consistency.
I'm interested you raised that point about customers being irritated by the checks you have to run under the regulations. Can I ask you something very specific about that? When you onboard a client, yeah, you do have to go through this very tedious process of checking they're not money launderers or yeah, drug dealers, or what are the AML, the KYC, the sanction screening, the anti-terrorist financing, and all that stuff. To what extent do you see a combination of technology and data as being able to make that process more efficient? Are you experimenting in that area, not just within Wealthify, but maybe within Aviva as a whole?
Not just Wealthify or Aviva, but the entire market. I think we come back to kind of partnerships again. Well, I'll refer back to your earlier question, why Aviva purchased Wealthify. One of the reasons was because we can do what we do at Wealthify better than Aviva could do it, just because of the kind of culture and makeup. And it's similar with KYC and AML as well. We will build what we can where it's most efficient for us to build it. But if there's other people who are specialized in it and are connected to better places and data that can supply us that data at a cheaper level than we can build it, then we should be exploring partnerships, whether it be me, Aviva, or other people in the industry. And we're certainly seeing that. We've seen a lot of improvements to get there. I think the onset of open banking in the last couple of years, particularly in the last 12 months, have helped that a hell of a lot. But it's slow. And I think that's probably been one of the most frustrating parts of this, is that had we opened up open banking a lot quicker, we'd be in a lot further place than we are now. And we'd be able to do things like AML, money laundering, even suitability, even beyond there. Provided customers are willing to for us to access some of their wider data to make that onboarding process easier, it could become a lot simpler if we were a bit further along on the open banking route, which we are moving along, and we will get there, but we could do it quicker as an industry.
Now, I know that Aviva is involved in the ties of the Tax Incentivized Savings Association, which changed its name, the Investment and Savings Alliance, I think it's now called, are running this project on digital identities, and I know Aviva is involved in that. You've seen the government's now taking steps to make it possible to lay down a framework, a template, if you like, for determining digital identities. Is that something you see as a huge cost saver in that onboarding process? Not just as a cost saver, but also maybe something which makes the customer experience more positive, because they can say, well, this is who I am. you know who I am already, and it's updated continuously. Is that an area of live discussion for you?
Yeah, I mean, it is, again, well, everything is balanced, isn't it? We'll come back to that word balance. So there are some customers who would prefer to answer those questions throughout than give people access to their full set of data. Mm-hmm. And there's other customers who are maybe more time poor, that are more willing to share data to have an easier, quicker life through different onboarding situations. And I think exploring both and getting that right balance and giving people options. I think that's another thing that technology gives. It gives people options. You should have the choice to be able to say, no, I don't want to use my data for that. I want to use it for this, and I'm willing to kind of spend that data knowledge to make this bit quicker or easier and cheaper, but not here. So I think I very much encourage that ongoing debate and work.
Gareth, one thing I'm hearing very strongly from everybody is that choice is important here. And if you're having to give customers a choice at the front end, the only place you're going to be able to save money, I assume, is in the back office, the middle office. How do you do that? What can you do? We've talked about partnerships, for example. Maybe there's outsourcing. The answer can't be just buy better technology. It must be more complex than that.
Yeah, no, absolutely. I think there was obviously, yeah, the idea of buying technology and streamlining all your processes and making the world a better place, I guess, doesn't necessarily. And I think that's probably a challenge for a lot of new entrants in the fintech space. You come up with arguably a brilliant idea. It can save time, it can save money, it can save et cetera. But then there's also the minor challenge of a lot of these institutions that you're looking to work with and sell into have 30, 40 years of legacy systems that might make that exceptionally difficult. And then that's just the evolution of the world over the last 40 years, and not by choice, clearly. So I think there's for me, it's around kind of having that that wider understanding of why that technology can have value and the approach to it. I think and that's something that you pick up from we're trying to work with these financial institutions on the B2B lens. So I do think one of the benefits we found over the years is the fact that we were typically, if we are selling to a client with existing alternative investments, private market offering, what we were typically replacing was email, Excel, PowerPoint. Now, the benefit to that is that we didn't need to talk to lots of legacy systems. We could arguably test new propositions, launch new platforms, launch new propositions for these banks fairly quickly and in quite a light touch way. But as soon as you start infringing on those broader frameworks and that broader back office, middle office infrastructure, then you need to really, really know what you're doing and have a super compelling use case, and you probably then need to go back to the front end, because really the main sell for the financial institution to be able to engage in that project, because it's going to be challenging, is going to be generating significant value far above and beyond what's currently there. So I think it's kind of that's probably the first thing. I think the second thing is kind of how we see the fintech space has shifted from that first way of the world, which was more kind of what I'd call a disintermediation play into a collaboration play. And I think the third wave of that now is not just expecting financial institutions with these challenges to take your product, another product from another startup, and another product from another startup, but it's how all those systems can be interacting together effectively before being presented as a proposition to the FI. And I think that's probably the most cost effective way and valuable way that you can implement change on a large scale in some of these big organizations that are facing the brunt of these challenges.
Sarah, Gareth is describing there a world in which you have a very efficient, or as efficient as you can manage, given your legacy back and middle office engine, but you still want this engaging front end. And I can see why, because when I first started looking at wealth management 30 years ago, the great thing about it was the clients were so sticky. They always stayed there. They had this close relationship with somebody. Does this new technologies, robo-advice, for want of a better term, make it easier for clients to leave, or is it a tool for making it easier for them to stick around?
I'm not sure I completely know the answer to the stickability question, but I think making it easier for them to start, and therefore you've got more coming into the market, and it's down to how you serve them. You know, I mean, we've talked about the efficiency of, or Gareth was alluding to, you know, where you were replacing very simplistic Excel spreadsheets, etc. It was an easier market. But I think, you know, what we've got now is we have got, and it's been raised in this call, we have got, you know, we've had the wave of the Payment Services Directive 2. We've had the opening up of banking data. We've got open banking. We've got open finance, which is sort of continuing to push the envelope. And I think what we've got here is we've got disruptors that are partnering with people who are expert in the market, and I've alluded to challenger banks and partnering with Wealthify in the past, and putting the consumer in control of that. You know, we know the regulations are there for the right reasons. You have to reconfirm your consent to share your data. You know, if I have an account with Wealthify through my Starling account, then every 90 days I'm asked to reconfirm that sharing of data. And this is an obligation on the respective providers, but it's there to protect the consumers. And I think when you start coming into that partnership model and that API model, and we know that the API is the part that people can move from one place to another because it's a standard interface, and quite rightly so, to allow a larger amount of products to be offered. But it's as I said, the stickability, is it not going to be all down to customer services and providing the right products at the right time? And that might be one of the things that takes you on to one of the other questions I know you're going to ask about, which is, where do people want their money invested? And I think at the same time here, you will always have to provide the consumer with the ability to invest where the consumer ethically wants to invest. And also sort of morally wants to invest. So, it's down to service at the end of the day.
Yeah, I agree with Sarah. It's the kind of consumer choice is really important here, that people will stick around if they're enjoying what they're getting, the experience they're getting at the price they're getting it. And people will come into the market if it's accessible and affordable, and they've got that choice to do that. So I think stickability will be driven by as people get over that inertia, either to enter the market or to move to look around from an existing provider. It'll start them to challenge themselves on how good a service am I currently getting, and how much does it cost to get that service, and can I get a similar service for a different cost elsewhere, which is exactly what we should be driving as an industry.
In that case, Andrew, there's a good question for you here. I'm a young person. I'm shocked by the fees, so I've started to manage my investments myself using independent tax wrappers and indexed funds. Is DIY seen by you as a serious competitive threat? And is the fintech universe supporting people's ability to do that?
I think there's a spectrum of products depending on what a customer wants to do, and I fully kind of support if a person has the knowledge and experience and time to self invest, then that makes a lot of sense to them. And there's lots of digital players in the market that give those customers access to those markets, and you can then bring your costs down if you do it yourself. Lots of people don't have that time, don't have that experience, and don't have that knowledge, or are worried about doing things themselves. And for that, you have more managed solutions like a robo-advisor, like Wealthify, that will manage that solution for you, so that you get your time back, and you can use their knowledge and investment knowledge and analysis to get a more diversified portfolio across the range of funds. And then you take that a step further. If you want to access an even wider array of funds and different investment mechanisms, and you've got larger pot sizes where it's economical for a financial advisor to look at larger pot sizes, then you've got that end of the spectrum as well. So I'm a massive proponent of having customer choice and having the full product set across those customer choices, and DIY plays part of that.
And passive, is that a serious competitor to you? Is that the one you worry about the most?
Well, we use passive funds, so I'm certainly not worried about it. It's I think it's had some really healthy challenge and discussion in the last few years around cost versus risk/return. I think passive has performed really well over the last 2 or 3 years. I think it probably outperformed active. It doesn't mean that's always going to be the case. And I think there's a market for each one of them. I think, again, it comes back to what do you want from a product and how much are you willing to pay? If you're wanting to stay in certain funds or a selection of funds and it's diversified and you want to grow with the stock markets, then passive is the cheapest and best solution. If you want some more active choices of management, then the active is for you. We use passive for our original funds and active for our ethical funds. And I think that plays a really good part into the ethical pitch, because you've got someone actively, regularly looking at your funds, and we have people regularly looking at those funds to make sure they're doing what they say on the tin, that they are ethical. And so they're both are relevant depending on what the customer wants to choose.
Yeah, well, we'll come back to ESG and crypto in a minute, but I'd like to ask Armin this question. If you were advising a wealth manager, would you say get out of active asset management, just go passive?
Oh, not at all. So this is a really interesting question, and one can talk about it in detail. Can
I ask it in a slightly different way then? Should you get out of asset management altogether? Subsection there.
Again, not at all. So obviously passive has outperformed active in recent in recent history, let's say. But I think this is the start of a very exciting journey for active, because never in history has active managers had access to such computational power, such advanced machine learning, artificial intelligence, etc. So if you really want to play the active game, I think the tools have never been this strong. And so going forward, I think companies that can tap into some of that type of active investing surely will contend for returns with passive investors. Also, regarding the question about fees, I think kind of tunnel vision and myopic emphasis on just fees itself could be counterproductive. The better question is, what are you getting for the fees you're paying? So what is the value added? Because it's really about the value added versus the fee, not just the fee. I mean, this might be a clumsy analogy, but if you're choosing between two cars and one's slightly more expensive, it could be that indeed it's the better option to go for the more expensive car because it gives you more mileage and it's less accident prone, etc. So I think it's really that. So what are you getting for the fee? So in my view, that debate is not settled. I think active still, especially with the tech, with the machine learning, with the use of technology, still has lots of things to say for itself.
Now we're heading towards our last 5 minutes. Time does go very quickly, but ESG has now been brought up, not just by panelists, but also by a questioner. Lots of ESG products are obviously greenwash. I like that, obviously. There doesn't seem to be anyone that can help me make choices. How do wealth managers decide what is and isn't greenwash? And that resonates with me, that question, because we did a webinar earlier this week, in fact, to Future of Finance, which we're talking about the paucity of data to enable asset managers and investors to decide what was and wasn't a green product. There's lots of service providers and data vendors out there saying this is a green product, but actually, when you drill beneath the surface, ESG is seems to be very little difference between funds which is not ESG and the funds which are ESG. You're nodding, Armin, and I'll come back to you in a sec. Perhaps Gareth, I don't know, you must be dealing with managers who are having to accommodate ESG products. How well are they doing it in your judgment at the moment?
Yeah, I mean, I can look at it from the private side, I guess, and yeah, I mean, one of the core trends that we've seen a lot of increasing demand for private markets propositions, hence why we're in business, and that's been driven by the clients of the banks, and it goes back to these kind of new generation of wealth creators that are wanting hands-on investment opportunities they can know, see, touch, feel, understand, and social impact has been a real big driver on that. So we've got a couple of projects with a number of banks. Barclays, we've co-launched an impact investing marketplace called Impact Agora. And I guess my observations is that there's lots of talk in terms of investor appetite around wanting access to interesting deals. I think, and investment opportunities that bridge together that idea, which previously would have been investment and philanthropy, trying to bring the two together so you can do a bit of both. And I think one of the big challenges at the moment has been access to high quality deal flow, which I think is an interesting, I guess, a similarity on the public side in terms of access to accurate ESG information. So there's a couple of challenges I think in the industry across the board, just because it's in its infancy. But I think what I'm probably seeing is lots of clients exactly having concerns around the validity of what they're seeing in terms of flow of ESG information. So hence then taking it upon themselves to just invest privately in investment opportunities that they are closer to, opportunities that they can get access to that are have more of a near-term impact to them. So maybe something that's affected them in their walk of life, or or something that they have exposure to in their local community, for example. They're the kind of demand for impact investments that we've been seeing, and perhaps I wouldn't be qualified enough to say, but perhaps that's because of some of their challenges they're seeing around really understanding whether these more larger traditional investments are truly ethical.
Yeah, I was going to see if Armand wanted to jump in there, but I wouldn't mind following up on that if that's okay. I completely agree with Gareth around the access of information on ESG is really important, and I think we should see that improve as we go. One of the just to respond directly to the question, the choice you currently have in the market is around number of exclusions. Really, that's what it boils down to. Some people exclude a couple of things. I think we're one of the stricter exclusions in the market, where it's weapons, adult entertainment, gambling, and tobacco. If you go one step further and do fossil fuels, you're moving from ethical into sustainable. I think there's only one fund that does that in the market. The reason why the right-hand side of that is so limited is because of the number of funds in the market. That you kind of can start with enough funds to have a diversified portfolio at the left, and the more that you exclude, your investment funds number of investment funds you can invest into go down, which means the diversification risk diversification ability reduces. So actually, one of the biggest things we need to see is an increase in the number of underlying funds, actively managed underlying ESG funds in the market that give people the ability to diversify ESG-based funds in the market, and then we can start seeing a lot more optionality in products.
Now, we're going to have to stop in a couple of minutes, so I'd like to put this futuristic-looking question. Now, Armand, you brought up the question of cryptocurrencies. Quite a lot of wealth managers I talk to are coming under pressure from high net worth clients in particular to invest in Bitcoin, Ether, and so on. And then there is the even longer term possibility for wealth managers, which lies in tokenization, the tokenization of securities, starting with private market assets like private equity, private debt, illiquid asset classes like fine art, collectibles, real estate, and so on. Is this the greatest opportunity ever for wealth managers, or is it just an incredibly complex area which they should probably stay well away from until it's better understood and more liquid?
I don't think it's the greatest opportunity ever, but it's definitely something to be aware of. I think there are opportunities in terms of investment diversification. These are increasingly being treated as alternative assets. Obviously, some of them are very volatile, but with the advent of, for example, stable coins and gov coins and central bank digital currencies, etc., in the crypto space, my anticipation is that we will see more stability in certain cryptos and certain coins. But you correctly mentioned other alternative assets being tokenized and therefore being able to be invested in collectively. And I think that would be a fascinating space to watch. At the same time, there's also elements of overhype in this landscape. So I think the difficult thing is to be able to understand what goes on, but also not getting sucked in the hype. And I do believe that if active managers completely stay away from this, they will miss out on some of the opportunities in the coming years. NFT is another one, for example. What will happen to NFTs in terms of as an asset class? Is this an asset class? Is this comparable, for example, to some of the other things that's happening? Still very early days, jury's out, but I think we have to just rationally and calmly look at this market and see how it progresses and assess it independently.
Thanks, Simon. Gareth, are clients pressing you saying I've got to get into crypto and NFT and security tokens, or not?
Interested in the concept around digital assets and tokenizations. We occasionally get quite a lot of website inbound leads around people who are building the revolutionary crypto that's going to solve all problems, and we should partner with them. I get a fair share of them, but I don't have many of the larger clients today. I think, as I said, a lot of the core challenges we've been seeing is how we can solve, engage in using technology and getting technology to the advantage. But I do see a big opportunity, caveat that by saying I do see a big opportunity in tokenization around digital assets. And I think, again, it's about getting those workflows automated, getting the processes effective, getting our clients truly engaging their clients with a great private market proposition. And then we can look at how we can, start moving into those kind of worlds. But there's a couple of things we're working on in the pipeline.
I was interested to ask you that because I thought private markets would be a ripe area for tokenization. So
I think it is, yeah.
And do you think there's education to be done with the clients in that area? How well understood is the whole concept of tokenization and crypto and NFTs?
I think from my side, I think there's a hell of a lot of information online in terms of views, and I guess some at different ends of the spectrum in reality. I think there's definitely an education piece across the board. I think on private markets and private assets. I think there's a bit of a gap in terms of people realizing it's how straightforward these investment opportunities can actually quite be once you have that understanding of the market. So I think the education piece is across the industry, but I think that will only come by getting some stability in those industries to be able to build a solid foundation and base from.
Sarah, last word from you, perhaps. Obviously, the way people buy banking services, financial services, insurance in general is changing. Could it be that the way they invest in corporate assets should switch from conventional equities and bonds to becoming tokenized?
I think you're right. I think lots of things are changing. We are seeing. The big question is it going to be 5? Is it going to be 10 years time? Will people own cars? Will they be on a subscription model such that they need a 4x4 today and a soft top tomorrow for whatever purpose they want that vehicle to move them from one place to another? I think there's lots of things changing, and I think also when we look at the ethical element of this, we're seeing new entrants in the market who are actually helping individuals to understand their spending in their bank accounts, let alone where they're investing. So I think back to the point, the biggest thing for me on this is being mindful of the change and the way people's behaviours are changing and their needs are changing. And it's about education. It's about education of the potential for tokenization, but it's also about the education of the value of getting into investing versus savings, because quite frankly, at the moment, very few people are making a lot of money by keeping money in pretty poor savings options or in current accounts. So it's education and just being mindful that the world is changing and humans and our behaviour and our needs are changing, and we've got to adapt.
Thank you, Sarah. Andrew, perhaps you could have the last word of all and wave us out of our very interesting discussion this afternoon. Are you at Wealthify thinking seriously about cryptocurrency and digital assets, as we call them, or security tokens or NFTs? Are these kind of on the radar, or are they active projects at the moment?
Well, they're definitely on the radar because it's a live asset and our customers are interested in them. They ask us regularly about them, so we need to serve the market appropriately. At the moment, cryptocurrency and kind of token-based assets are quite volatile, and they're more in the speculation space for me rather than investment space. It's people making investment decisions to make a short-term turn on them. And at Wealthify, we're after long-term investments, so they're not in our investment portfolio yet. If they start settling down and becoming less volatile, then they could be in the future, but they're not at the moment.
Good. Well, I hope you'll come back and talk about this when we're a little bit further down the road and the market has matured, because it's a very interesting future prospect for us. But I think we've run 5 minutes over and I've been enjoying it rather too much. I'm sorry for that. But we better stop there. I'd like to thank our panelists, Sarah Williams-Gardner from FinTech Wales, Andrew Russell from Wealthify, Professor Eshraghi from Cardiff University, and Gareth Lewis from Delio. Future of Finance, our next event is this coming Thursday, 20th, is it next Thursday? I think it is, yes. We're going to be discussing foreign exchange, which is a market which is affected directly by cryptocurrency developments. So with that, it's goodbye from the five of us. And thank you also to the audience, of course. I mustn't forget you. Thank you.
Thank you for joining us. You can find this discussion on www.futureoffinance.biz and indeed other planned webinars under current events. I am Wendy Gallagher. If you would like more information about how to work with us, please do email on wendy.gallagher@futureoffinance.biz. Thank you once again.